Welcome back. Gold topping $4,000 an ounce for the first time ever and hitting another record high just this morning. Our next guest is out with a new piece in the Wall Street Journal about gold's rally, saying it points to eroding faith in central banks. Let's bring in Wall Street Journal chief economics commentator Greg Yep. That's nothing new, right? That gold bugs have wanted to diversify away from fiat currencies. What's interesting now, Greg, is that it's happening as stocks rise, and even some dollar strength here as well. What do you make of it?
Yeah, so first of all, it's entirely possible that the rally in gold is kind of like the rally in almost everything else that's going on, from crypto to AI stocks, that it's partly a speculative frenzy. You know, I am the last person to judge on whether gold is overvalued, but it has a bit of that sort of frothy feel to it right now. But if we want to get into the fundamentals, I think, as you said, it has traditionally been a hedge against a weak dollar, the other sort of classic reserve currency. And there have been a lot of reasons to worry about the dollar this year, from Trump's trade war, which seemed to signal a U.S. withdrawal as guarantor of the world's economic stability, and his attacks on the Federal Reserve, which all else equal suggest we're going to have essentially an easier monetary and easier policy and higher inflation in the years ahead. But what's interesting, I think, this week is that, as you said, the dollar's been relatively stable recently. But look at the election in Japan, and you have a new prime minister there that sounds kind of Trump-like in her criticism of the central bank there, raising interest rates. So one could look at this rally in gold as not just a hedge against the dollar, but a hedge against all so-called fiat currencies like the yen.
Right. Yeah. So do you see Bitcoin rising for the same reason?
You know, Bitcoin has a little bit of that flavor too, right? So Bitcoin is kind of like digital gold, right? It doesn't have pay any income the way gold does. It's seen as a hedge against, really bad outcomes and so forth. Historically, though, at least to the extent there is a history for Bitcoin, it has tended to sort of move with stocks. It feels like it's more of a risk-on asset. Gold, the case for gold typically was that it was a hedge against all these other asset classes, especially in times of high inflation. But as you said at the outset, this rally comes as stocks themselves for gold. So whether that historic hedging property persists in the next few years, I think, remains to be seen.
I mean, overall, the reasons you laid out for why gold is rallying is bigger policies on the fiscal front, more expansive policies on the monetary front. Some might call irresponsible, spending and easy policy. All of that isn't ultimately good. So, is this a warning sign for stocks in the long term?
I think it's a warning sign for the world and for us for economies in general. I mean, look. It's no secret that the world in general is awash in government debt, huge levels of government debt. Japan around 200% of GDP, the United States closing in on 100% of GDP, and enormous deficits and no political will to address those. And so should we be shocked to hear that politicians are looking for the easy way out to essentially monetize the debt, inflate our way out? And so I think that's the kind of thing. Just look at the fundamentals out there between the high debts, the low growth, and the populist politics that are taking over every major developed market. You've got to worry about the essential integrity of currencies and the central banks that stand behind them. That's a good story for explaining why gold is going up. Whether that's a good reason to own gold at $4,000, I don't know. But to the question you ask, it is absolutely a warning sign to pay attention to.
Greg, even critics of the tariffs had to admit in recent months that it was potentially a way to address the deficit or the debt, and you would think that would have been bond market friendly. Now we're starting to hear, well, maybe we'll use some of the tariff revenue on a farm bailout. Maybe we'll use some of the tariff revenue to rescue supplemental nutrition assistance. Would you expect the bond market to respond to that?
Oh, I think there's a couple. I think, Carl, first of all, you're absolutely right to point out that if Trump's tariffs were all that were on the table, then you could say that's deficit friendly and bond market friendly. But as you say, the president seems to have a bunch of other ideas about how to spend that money. I've heard him say we should send out $1,000 to $2,000 tariff dividend checks to folks. The shutdown that we're going through right now is all about whether we're going to spend more on health care. And even if all that revenue from tariffs went to deficit reduction, we'd still have a deficit in around the 5.5% of GDP level, and the debt would still be rising as a share of GDP. Look, you don't have to just listen to the president's own words. There's no seriousness there about dealing with the debt or deficit other than these kind of some questionable approaches like forcing the Fed to keep interest rates lower.
All right, Greg, we got to leave it there, but I'll throw one more stat. Gold surpassing the euro to become the second largest global reserve asset after the dollar recently, which shows you how much stocking up there's been. Greg Ip from the Wall Street Journal, thank you.